Imagine if someone could summarize your entire financial discipline into a single number. Well, they can. That's your credit score. But here's the part most people don't understand. The credit system was created to punish you. It was designed to measure risk. And if you understand how it works, you can use it to build generational wealth instead of being controlled by it. Back in the 1800s, there were no credit scores. If you wanted to borrow money, lenders just relied on your reputation. Merchants would literally write notes about their customers in ledgers. If someone in town thought you were unreliable, that opinion followed you everywhere. Then, in 1841, the first commercial credit reporting agency was created. Businesses started formally collecting financial information to reduce their risk when lending money. Over time, that small system evolved into the national credit bureaus we know today. The goal has always been simple: reduce uncertainty and predict who will repay their debts. Now, let's fast forward to 1989. This is when the first standardized credit scoring model was introduced. Suddenly, it wasn't about opinions anymore, it was all about data. Lenders started looking at your payment history, your total debt levels, the length of your credit history, the different types of credit you have, and any new credit inquiries. The system became purely mathematical. And the most important thing to remember. A credit score doesn't measure how wealthy you are. It measures your consistency and your risk-taking behavior. So, why does any of this matter for building generational wealth? This is where most families get it wrong. They treat credit emotionally instead of strategically. A strong credit profile is a powerful tool. It allows you to secure lower mortgage rates, which saves you tens of thousands over the life of a loan. It lets you finance rental properties that generate passive income. You can use it to fund a business expansion. Essentially, it drastically reduces your interest costs over decades. Think about it. Lower interest means more of your money stays in your pocket, more money that can be invested, more invested money that can compound over time. And that compounding is what builds a real legacy. If you overpay on interest for 30 years, you're just transferring your family's potential wealth to the lenders. But if you manage credit strategically, you can redirect that exact same money into assets for your children and grandchildren. Most families don't talk about credit until there's a problem. But families focused on generational wealth do something completely different. They teach their kids early. They explain what a credit score is and how interest actually works. They emphasize why paying on time, every single time, matters so much. And crucially, they teach how leverage can be used to build assets. Your kids shouldn't fear credit. They should understand it as a form of leverage. Used wisely, credit helps you purchase appreciating assets like real estate or a business. Used poorly, it just funds consumption of things that lose value, like expensive gadgets or flashy cars. That single distinction can determine your family's entire financial trajectory. So, if your goal is to build family-focused wealth, here's a simple framework. First, protect your payment history at all costs. Sits the foundation of everything. Second, keep your credit utilization low. Stay below 30%, but ideally, keep it under 10%. Third, avoid making emotional debt decisions. And finally, use credit to buy assets, not liabilities. Your children are always watching, so model this disciplined behavior for them. Credit is a financial tool, and like any tool, it can either build or destroy. The credit system wasn't created to control you. It was created to measure trust. The question isn't whether credit is good or bad. The real question is, are you building a financial reputation that is strong enough to pass down opportunity to the next generation? Because generational wealth is never an accident. It's engineered. Thanks for watching, and be sure to subscribe for more insights on building your family's financial future.